Exela Technologies has perhaps tried to do something to add some respectability to their stock value. However, it seems to be blowing up in their face big time. Hi again everyone, I hope you're all doing really well. So it seems to be a trend among some retail stock favourites to be undergoing stock splits at the moment. Perhaps emboldened by the actions of Amazon and Alphabet, GameStop also undertook a stock split about a week ago. Changing things up, this week Sundial Growers and Exela Technologies both undertook reverse stock splits just on Tuesday. Unfortunately for Exela Technologies, ticker symbol XELA, the focus of this video, this stock split has proven to be a disaster for shareholders, at least at the moment. Following the close of trade on Monday, the XELA board had voted that a 20-to-1 reverse stock split be implemented on the next trading day. What this meant for Exela Technologies investors was for every 20 regular XELA stocks that they held, these would be converted into a single stock. The idea of doing such is to reduce the total number of shares outstanding without theoretically changing the underlying value of the shareholder's investment. So what actually transpired? Well, the XELA share price closed Monday's session at 14.5 cents per share, having mounted somewhat of a comeback in the previous fortnight from when it had hit an all-time low but at some point below the 10 cent per share mark. The catalyst for this comeback was perhaps partly the extremely low price point in combination with the prospect of a major asset being offered up for sale and the subsequent plans of reducing debt and possibly undertaking a share buyback with the proceeds if this sale does eventuate. So beyond that speculation, at 14.5 cents per share, that meant the now consolidated XELA share price following the reverse stock split should be around the $2.91 mark, which was roughly where the stock did open up on Tuesday. Since then, it has been absolute hell. The stock dropped by about 30% on Tuesday and a further 15% on Wednesday. Keep in mind that this 15% drop occurred in the face of strong Jerome Powell-inspired rally across all major indexes, particularly the tech-heavy NASDAQ. Currently, the XELA stock price is at $1.56, so in pre-reverse split terms, that means the stock has fallen from 14.5 cents to 7.8 cents each, or a touch over half of its value pre-split. That is basically putting it back in the range of the all-time lows it achieved earlier in the month. So I'm not going to try and do any technical analysis or give some price guidances for where I think the stock could move to in the near future, as there's still a great deal of uncertainty with the company following the reverse stock split. Previous to the split, the stock had managed to get back to the 20-cent mark at one point, which would be $4 today. To achieve these recent highs again, we would need to see the current share price float back to the $4 per share mark, which, if realized, would be about a tripling in value from where it is right now. What is quite interesting is if we see what this reverse stock split does to the existing analyst expectations and price targets. At the moment, there are a wide range of price targets, with the lowest being $7 per share, the highest being an eye-watering $60 per share, and a median expectation of $33.50 per share. Basically, this is because there are only two analysts covering the stock, and we need to split the difference. Both of these guidances actually go back to March. And to put it simply, these price targets are probably a bit outdated now, as we are in a far different macro climate to what we were back then. Even still, and not that this is investing advice, these price targets represent at the minimal end a 430% upside, or at the top end a 4,000% plus upside on the current share price. On another note, what this split has actually done is it balances the underlying asset values of XELAP preference shares with that of the regular XELA stock, as XELAP shares were created through exchanging 20 regular XELA shares for one of the preference shares. Not that a company valuation is the same as an analyst valuation, but this would suggest that the newly consolidated XELA share prices may be perceived by management as having a similar value to how they view the XELAP shares, which they have pegged a liquidation value of $25 to. Keep in mind that the existing shares would not have this and would only have a residual liquidation value, which currently, given the levels of debt from a few years of big losses, would actually be negative. Not that I think XELA is going to go belly up anytime soon, despite these ongoing financial woes. Still, I think that XELA is undervalued despite its huge pile of debt. In old price terms, it is valued at about 7.8 cents per share, which is pretty much another low point. With a potential sale on the cards of a major asset, the reverse stock split could eventually go some way to returning shareholder value in the longer run. This is a company that does over $1.2 billion a year in revenue. It's a big company. On the flip side, I've often wondered just how low can this stock go? Theoretically, the underlying value of the shares can actually now go even lower now that the reverse stock split has occurred. Not that that's what I'm hoping for. Anyway, that's about all I'm going to say for this one. I'm glad that my main interest in the stock is still the preference shares. However, I had made a couple of small speculative purchases in the past few weeks at the recent low points for XELA stock. So I'm watching with interest what happens now. Anyway, let me know your thoughts on this recent stock split in the comments below. Are we going to see a further slide in the price, or are we now expecting a bit of a turnaround as punters start to readjust their expectations for the stock? Until next time, everyone, may the markets trade in your favor. Cheers.